Hello and welcome to the Monday Futures Market Outlook for Tuesday, May 22nd, 2012. We are doing the forecast one day late, but we are still going to forecast for the week. For those of you that have not had the opportunity to try out our eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we've been bullish on the U.S. dollar, not only in the long term, but we've been waiting for the opportunity to actually become short-term bullish on the U.S. dollar index. We were looking for this overhead resistance level sort of to be the line in the sand for becoming short-term bullish. We don't like to switch over to a short-term stance like this without there being a pullback and subsequent some sort of a pivot break. But any price action above $82 will really be the environment from which we will be looking to become the short-term bullish to complement our long-term bullish outlook. We still do believe that U.S. dollar index will head up toward the 84-85 level, and that we even have some bigger picture targets that could see even as high as 88 or even 90. But we first want to take it one step at a time and first actually see just a bullish technical push above this 82 level to at least give us an indication that some sort of a trend has actually begun in the bigger picture. A lot of the forecast on the bullish U.S. dollar comes from looking at the euro. So here when we look at the euro FX futures contracts, you can see the euro is now consolidating right at the 126 to 127 level on the downside. While we actually do believe there's plenty of room on the downside of the euro, we're not 100% convinced that it's straight line down from here. This is a major support, the January low, and but a substantial violation of this level on the downside really would open up the floodgates all the way back down to the lows from several years ago around the 118 to 120 level on the downside. So we're going to be watching very closely here, but we do believe in the bigger picture that the euro is destined to have further deterioration and weakness. We're just simply, again, not convinced it has to happen immediately. We would not be surprised or feel it's out of line for the euro to potentially strengthen back to 129 and even under the right circumstances back to 130 during these kind of periods of consolidation. But without whether that consolidation ends here within the next few days or ends a few weeks from now, we are ultimately looking for a break of the 126 level on the downside, which would really at that point put us short-term bullish to U.S. dollar. Next year, I want to take a look at the 30-year Treasury bonds, and the Treasury bonds have now broken to all-time new highs, and this is obviously following suit of the 10-year Treasury bond, which has spent already a few additional weeks above 52-week new highs, or actually all-time highs. Really, at this stage, these 30-year Treasury bonds are overdue for consolidation, and you can see that we are seeing some selling coming in here on that 30-year Treasury bond, but we are not looking for that selling to last long or to be very intense. In fact, any proper multi-day consolidation down to test the 145 level and potentially even on the short term 44, 43, as long as it finds immediate support, will probably represent a buying opportunity on the 30-year Treasury bond. We are bullish on these bonds. We are just needed a short-term pullback in order to change our to complement our long-term bullish bias by adding the short-term bias along. Next year, I want to take a look at copper futures, and copper has finally deteriorated on the downside in the past week and a half. We've now seen this technical breakdown. Again, there is room for copper to, on the short term, strengthen maybe back to 360, 365, but we do believe a new downtrend has begun here. We are on broader base of commodities bearish on both the short term and the long term. We believe that in the bigger picture, copper will not only see this initial swing low around that 3.25 area where the lows came in November and December, but we could very easily test $3 on the downside or even $2.75 later this year. At this stage, we are of the conviction that any short-term strength is an opportunity to not only lighten up on any existing copper positions, but to maybe even go short copper. Next year, I want to take a look at the E-mini crude oil contracts, and we want to take a look at what crude oil has done. And obviously, the selling has been very intense. We've adjusted our focal point from the 93 level down to this 90-92 level just because of the intensity of the selling on the downside to find a next level of support. Inevitably, at some point, it's likely that crude oil will have some short-term strength, maybe bounces back to 94, 96, maybe even as high as 98. But after any short-term strength up to those kind of levels, we are looking for crude oil to resume selling. Of course, we want to emphasize that there is obviously some geopolitical risk that if some confrontation was to occur, that it would change the risk premium that's being priced into oil, especially if it's coming from the Middle East. But beyond that kind of an input variable, the trend lower on crude oil should dominate. Next year, I want to take a look at gold futures, and we've talked about gold retesting this 540 to 560 level on the downside. After that, tested that zone, the buyers came back very quickly, bouncing gold back towards the 1600 level on the upside. We, in fact, still believe that there's even room for gold to temporarily trade even as high as like 1620 to even 1680 on the upside, which could probably happen over the short term. But we are continuing to anticipate gold to continue to sell. Now, even if that upside target isn't hit, which we do believe it has a reasonable chance of going up there, when the selling ultimately resumes in gold, we will be looking for drops down to the 1440 to 1460 level. But there are different targets that we can measure out that even go to the 1400 round number, or is even as low as 1350 on the downside. So we do believe that even if there is some short-term strength on the upside of gold, the trend probably for the summer will lead to continued deterioration in gold prices. So that brings us to wanting to look at the stock market, and we start with a weekly chart of the S&P 500. And when we put 3 decades of charts with an 80-week moving average on there, it's done a very good job to depict the bull and bear market cycles that we've gone through. There were a number of false starts in 2010-11 with breaks below that moving average, but overall the trend remained up, and the price action remained above there. Interestingly enough, we are now finally trading right back into that 80-week moving average, which relies right around the 1290 level, where we did just print the lowest levels last week. Really, at this juncture, this is going to be a crucial place on this market trend, because if we have any breakdown of this 80-week moving average, it is the environment from which we change to more of a longer-term bearish stance rather than remaining neutral. So this is a level we're going to be watching very carefully. It has a bigger picture implications from our analysis, and we're going to be watching how the market behaves and reacts at these levels. When we break that S&P down onto a daily chart, we just now have 2 levels that we want to watch. Obviously, the highs came in at that 1400 level, and we currently got that bounce right off that 1275 to 1290 level, which is a focal point we've been watching over the last couple weeks or month or more. Now that we've initially met that first target, we're going to get some form of a market bounce. We're looking for that market bounce at this point to come up towards the 1330 to maybe even as high as the 1360 level on the upside of the S&P. And there could be a lot of things where we see the market trade back down to 1300 or 1290 and then trade all the way back up. One way or another, it's very natural for after a big wave of selling like we've seen for the market to go through a consolidation period. In the bigger picture, again, just like we've suggested in the previous slide, there is room for the stock market to actually become relatively bearish, particularly since almost every global indice is in full sell mode outside of the U.S. So there is definitely room on a comparative basis for the markets to continue to weaken. So we're looking actually at lightening up on positions into this strength, and actually potentially even using the short-term strength as a place to engage new short short positions. We do believe that even if the stock market does rally here, it will not be able to exceed its previous highs, and again will probably still yet make lower lows in the upcoming period. There's even scenarios where we can see 1200 or lower on the downside of the S&P as we approach the middle to late summer. Just to highlight our key intermarket observations, we are short-term neutral on that U.S. dollar, but like we were pointing out there, if that euro makes that breakdown and the U.S. dollar makes that breakout above there, we will be very anxiously looking for the right time to be able to switch that to a bullish stance on the short term to complement our long-term bullish stance that we've had for a good part of the year. In the same regards, we already switched to a bearish stance on commodities on both the short term and the long term, and remain there. Even though there might be some short term bounces, we don't believe that anything warrants us changing this perspective on the commodities. In the same with bonds, even though bonds have already broken to higher highs, the one thing we are reluctant to do is by switching the short term stance to bullish. We don't want to give the impression that that's the moment to actually buy. It's not really meant to be a market timing signal, but rather an indication of trend. We'll wait for the bonds to consolidate here, and if they hold up properly, we will almost immediately switch that bond outlook to bullish in that environment. In the same regards, just a quick comment on the stock market. We are bearish on the short term, but we remain neutral on the long term. But recognize that 80-week moving average that's on there on that weekly chart, that's roughly around that 1280, 1290 level. If we have price action that is distinctly on a weekly basis closing below that level, would actually change our long-term stance on the market to complement that of our short-term bearish stance on there. So we may actually have all of the short-term signals complementing our long-term perspectives, all probably within even a couple weeks, and we'll see how that trend develops over the upcoming months as we go into what could be at this point a difficult summer. That was your Monday Futures Market Outlook. Thank you for joining me.